All right, so welcome back to the Multifamily Live Podcast. We are super excited for today's guest, Joseph Shalaby. Hey, Joseph, how you doing?
I'm good, thank God, sir. How are you?
I am doing great myself. And a little bit more about Joseph. He's the founding broker and CEO of eMortgage Capital, Inc., a full-service mortgage company that offers extensive options for residential mortgages with quick service and lending rates. Joe is a UCSB alumni, graduating with honors in 2002. He's been in the mortgage industry for more than 2 decades, working hard to stay on the cutting edge of new mortgage projects and alternative mortgage options. Innovations are what allows his clients to select absolutely the best loan projects customized for their individual situations. So talk to us a little bit here, because we've had a pretty interesting, year plus of changing the narrative where we thought there was going to be continually from our side, residential and multifamily and other, a lot of changes that would come about getting harder to get loans and other points. But where we've seen is that the market's exploded, right? The drive and demand have been very, very heavy, where people want to move to select areas. And, in most parts, housing supplies have been at a deficit. And even recently on some of the Fannie and Freddie products, we've actually been seeing a lot of the reserves that have put in place starting to eliminate or slowly backtrack. How have you guys been navigating the last 12 months? Catch me up to speed.
Well, so overlays have actually, believe it or not, started to loosen on all Fannie and Freddie products. So financing in general has become a little bit easier. And we just rolled out a new jumbo product. It's actually much more aggressive than any jumbo product we've ever had. It goes up to 90% loan to value, no mortgage insurance. And the rates are the same as regular conventional rates. So this is now post-COVID. Pre-COVID, you had the issue with like self-employed borrowers. Those loans were pretty much impossible to do. The majority of our investors pulled out, and we even processing them decided to really just take on friends and family to process self-employed loans because of all of the additional overlays as a result of the pandemic. So, during, all pretty much from March through December, we really just took your cookie cutter W-2 clients, and case by case, we'd work with self-employed clients. But all of the overlays because of the pandemic, whether it was value, whether it was employment, whether it was forbearance arrangements, because there were so many people basically going into forbearance, not making mortgage payments, they started very, very strict. And then as Fannie and Freddie kind of identified how much government intervention would actually commence, those guidelines would start to loosen as the government would inject their stimulus funds. So as we kind of see the government intervention, you'll see these guidelines being mitigated and eventually being eradicated altogether. And then that's basically what's happening right now with all of the loosening of guidelines. We're back to taking on people who are right out of forbearance or actively in forbearance right now. We can take care of all of their back paid arrangements in the refinance. So we'll just lump it all in and refi them. And that would be like, for instance, like in 2008, that's something that would be impossible. Like, what? You're going to catch up all my back paid arrears? Something that concept would be, so far fetched, but all the government subsidies and all the government intervention has really made that a reality now due to, the $2 trillion stimulus, the recent $2 trillion stimulus, and prior to that, however many trillions they injected. So we're starting to see a lot of loosened guidelines on that. And I think we'll continue to see more loosening of guidelines. Like, we recently rolled out, we can do a 30-day late, an active 30-day late on a mortgage. There were some new updates even today.
What would that be, an active 30-day late on the mortgage?
So someone who had a mortgage late, like not just who was in forbearance, I'm talking a full-on 30-day late. They missed a payment. They didn't apply for the forbearance. They just missed a payment. The forbearance, that's identified as a forbearance on your credit, and that has its own set of guidelines that basically allow forbearances to happen. And then whatever's on your mortgage statement, like let's say you're 10 grand or 12 grand or 15 grand in the arrears, we could lump that into your final payoff and just include that into the refinance as part of the payoff itself. But a 30-day late is basically you just didn't make your payment. We're allowing that on a straight up A paper loan. And that's never existed.
Meaning with that, they're not current on their mortgage, they can still go in there and get a refinance into a new more attractive loan.
And if they're not current and they didn't apply for forbearance.
Wow.
So
what are some of the competitors that eMortgage Capital are competing with in the space right now?
So eMortgage Capital, our platform is very, very unique. We're the first mortgage banker in American history to offer a raw rate sheet without a pad on it. So traditionally mortgage bankers have like 100 basis point pad. This is like, this, if you don't understand what I'm talking about, I can elaborate more, but a mortgage banker has a pad on their pricing schedule. We don't have any pads on our pricing. We give our branches a raw rate sheet. This allows them to be ultra competitive, especially when it comes to competing against, your local, your big mortgage banks here, like Network Capital or Loan Depot. We really kind of just destroy all of our competitors in pricing, and we're a hybrid model. So our competitors in our space are companies like C2 or CAM or Nexa. These are like big mortgage brokers. But the difference for us is that we're a mortgage broker and a banker concurrently. So we offer both options for you to bank your loans or broker your loans. Think of it like I could basically turn you sitting in your living room right now into a bank. That's what we do. We turn individuals working from home into banks, individual banks. You're lending millions of dollars from your home in your pajamas. It's just an unbelievable concept.
Very interesting. And so talk to me where you can cut back the 100 bips here. Is that you're talking on the rate in general or the fee structure that people?
Yeah. Like so an interest rate, let's say it's 2.99%. It's paying back to us today, like, I don't know, about 190 basis points or something like that. Traditionally, a banker would say, okay, it's paying the banker to 190 basis points. But then the branch that they recruit, they'll pay them 90 basis points. So the banker will keep 100 basis points for themselves. And then the branch under them is working off of what we call a padded rate sheet. So there's a pad traditionally about anywhere from 1 to 200 basis points for any mortgage banker. Now we offer this like hybrid platform. So it's, it gives a ton of flexibility and enables people to make more money, have more flexibility, offer better pricing, and fund the loan with ease, because we don't underwrite the loans in-house because we do so many loans. We do 1,200-1,500 mortgages a month. We account for about $500 million monthly fundings here, but we control the funding. What's kind of unique about our platform as well is we have this thing called flex funding. We're not limited to the Federal Reserve cutoff. So we basically, it's just like as if you're transferring money from your own bank account. We can fund loans on Christmas. We can fund loans on weekends. We could fund loans on Sunday, So it's pretty impressive how we have this funding flexibility, whereas most banks cannot do that. So that's one of the real benefits too, is that we're not limited by the Federal Reserve in terms of a cutoff. So
interesting. So you basically pool funding, and on that part, you're able to take advantage of it on these usually opt-out days that of course banks aren't open, right? So holidays, weekends, and everything else from that fact where you miss the closing on Friday, which the death of most projects are closing on Friday because it's never going to happen. It's going to get pushed to Monday on the following weekend. You could carry that over and say, no problem, we'll get this done on Saturday.
Correct. So it's very, very helpful for people, especially when they're trying to purchase a property or they have those deadlines that they have to meet. Realtors love it, to have flex funding because they're never worried about missing their funding date.
What is the typical? So you've said now that you've gone back, of course, because being self-employed in my world myself, it's a whole different string of challenges, we'll say lightly, if you do want to get loans, right? Especially when we have a lot of multifamily investments on our side with the accelerated depreciation. It carries that whole different analogy on that stance. So what is it from your point in terms of who is the average person coming to you? You're doing 1,200 to 1,500 mortgages a month here. Who is the person that's coming to you most and foremost? Is it your typical first-time home buyer? Is it a mix of solo? Is it people now looking at trying to refinance? Talk to us a little bit more about that. Where are you seeing the numbers today?
So we're seeing, I mean, still there's a huge, our primarily right now, our focus still is refinance transactions, cash out transactions. But the standard, because a lot of people missed the wave, obviously, during the pandemic or couldn't qualify. What you're seeing right now is a lot of people going back to the workforce who can qualify. A lot of people who are in forbearance who weren't able to qualify who can qualify now. A lot of people who have, debt overload from the pandemic or prior to the pandemic who need to do a refinance and pay off all their debt. A lot of people, I don't know if you're following what's happening with construction, but it's booming more than pretty much, it's like a historical how construction is booming right now. So a lot of people are cashing out and renovating, fixing properties. A lot of people we're at a massive scarcity in real estate, right? So, investment properties, second homes. I mean, people are trying to snatch up what they can. So we have a lot of purchase transactions, second home transactions. And what's going to really take off for us is that we just released March 17th is the jumbo product. I mean, we didn't offer jumbos for an entire year. Can you imagine? The average home in Orange County is like 900 grand, and there was no financing available for jumbo from basically March till March. So that was a 12-month period where jumbo financing became almost obsolete. And those that were getting jumbo loans, it were, you had to go through Chase Bank or Wells or your local bank. But you know how loans are with them. It's just an absolute nightmare to get those loans done. So they were closing at a fraction of the pace that we're about to start to see in the jumbo marketplace. Now, if you thought that values jumped during the pandemic in Orange County or in larger value markets, now because of the addition of jumbo financing, you're going to really see values uptick even more so than what you've seen in the past. Not to mention, and I talked to a couple of people, and what we're seeing right now, because there's a shortage of housing, is we're going to see even tighter inventory coming up because first-time home buyers, we're about to see millions come to the marketplace because of birth rates. Birth rates 33 years ago, exploded. So what's happening now, people are like, well, inventory's tight. Well, inventory's tight because of birth rates in the United States 33 years ago exploded. So inventory is even going to get tighter now. So as we see inventory get tighter, you'll still see this like demand. People are paying, if you can buy a house 5% over asking right now, that's a deal. Yeah. That's like you're winning. There's certain locations in Northern California where I'm seeing, people offering 30% over asking and getting denied, So, I know you guys are in the multifamily space, and commercial thankfully hasn't been hit as hard. Multifamily hasn't been hit as hard. But I think that multifamily right now is going to also swing upwards drastically right now, especially with all the new financing availability.
Yeah, I agree. It's been the darling of the space, right? We saw, of course, so many other sectors, retail, office, just really get crushed, and now so much money has moved over from there into this space, and it's really just driving it. That coupled with where cap rates are and where interest rates have gone, it's made this very interesting spot where a lot of things have been accelerated, even for some of the hold periods we had, And so we look at that from a point, and where does that stop? I don't know. But we, even from the point of housing constraints, you look at that coupled with where you would think construction costs have gone, still you're seeing people build. They can't build them quick enough right now. You can't get enough product out there, and it's never going to compete. How are you, we'll say, mortgage capital, looking at different markets, especially some of the markets that may be in cities that have been harder hit based on net migration compared to other markets? How are you really? Is there certain areas that you're staying away from still based on that, or are you really just covering the basis based on property and performance?
Well, here's the deal. We're actually doing the opposite. We're just expanding our overall footprint. So like yesterday, we added the entire state of lending in Maryland. So we're not so geo-targeted like you guys may think are a traditional realtor. We're in 14 states right now. We intend to be in 20 states. Last year, we did about $4 billion worth of volume. Obviously, it was the biggest refinance boom in history, but we did $4 billion worth of volume with about 150 loan agents, and we were only approved in 5 states. This year, we intend to double the amount of loan agents we work with, and we're going to triple the amount of states we're in. So we're going to be in this probably, or quadruple the amount of states we're in. So we're going to be in about 20 states. We're going to have about 300 loan officers, and even doubling the amount of loan officers and quadrupling the amount of states, we might only do 6 billion or 8 billion, but we invested way more in resources just because we were preparing for a slowdown, a massive shift because obviously the refinance boom, 2020 was the year of the mortgage broker. People were caged in at home. They only thought of their house, and rates hit historic lows. And all people can think about was doing a refinance because this is like they're caged in the house. They were like imprisoned in there, So that was like their number one priority was to refinance and like mitigate that cost. And that's why we saw, the refi boom of 2020. I say 2020 was the year of the mortgage broker. It was the year that really just every mortgage broker catapulted in their career.
What do you see from markets? How are you identifying now? You say I think you said in 14, looking to be in 20. How are you looking at certain states for where you want to be? Is it just simply just on the criteria, for getting approved, or is there certain areas that you make sure?
No. We look at loan values. We look at where people are migrating, and we look at population. There are some states that we just kind of added because the values were high, like Wyoming. Wyoming has like no population. There's only 500,000 people in the whole state, but because 97% of the land is protected there. But the values in Jackson Hole are it's like Beverly Hills, right? It's average home is like $10 million. So we look at values as a major reason to get approved in that state. Like Maryland, the average home there is like 500 grand.
Yeah, sure.
But there's states that are really, really, they just take a lot of time and effort to get approved in, like New York and Nevada, which we're going to be in an application stage with them for probably 6 to 12 months just to get approvals in those difficult states.
Go ahead.
But millennials is what we track a lot, because they make up a big portion of first-time home buyers and refinances now because they bought several years ago.
It's really interesting because we're actually, you look at the same thing on the back end from our side, from the investment standpoint, migration, population growth. We're looking at values, which really come from job growth, really where we're seeing on that part, so it's interesting to see it from your perspective on the lending side, how you're identifying new markets to go into, because it's really very similar on how we're identifying from there. How has the move really, e-mortgage, of course, so a lot of this is done online without really having to go and do your typical, song and dance going into the bank, in person. How has that really accelerated your ability to do 4 billion in volume compared to the traditional bank that's still stuck in their quote unquote box, where if you're not meeting their box criteria, which is a lot of people, you're ultimately just X'd out before you even get started? How has that really engaged or enabled you guys to take so much action?
So we're able, because of the fact that everything is electronic, everything is like e-sign, we're able to scale. Can you imagine, your local bank doesn't do $500 million a month worth of refinances. They might do 10 million, we're doing, 20 times or 50 times your local bank's volume because everything is streamlined, automated, digital, and we continue to make the process faster, easier, cheaper, digitized. And, the more technology has its hands in our business, the more the process will be faster, the more it'll be easier, the more it'll be cheaper. And our goal is to get loans in and out of here in 10 days. We're trying to move loans out of here in 5 days.
Wow.
From beginning to end, because, we can pull the automated appraisal, we can pull all your financials, we can pull everything within minutes. So, your bank, they don't leverage technology. Their CEO isn't, on the front lines figuring out how to automate solutions or how to make this process faster. Their CEO is sitting back, somewhere else and has no involvement in the process. So, your brick and mortar locations, they're very, very archaic in the way they do their business. They will continue to be archaic because there's no one really in their leadership on the front lines strategizing how to make the process better. And that's just gonna, the old bankers, they're gonna kind of die out. They're making their, we're getting calls from executives at Wells Fargo or Chase. They're like, our pipelines are dwindling because they're adding more overlays during the pandemic. They're adding more risk they're scrutinizing the client even more, and they're not giving us more swings. We're not getting remotely close to the amount of leads we were getting. So wow. Their loan officers are starting to worry, and they were already underpaid. We got our loan officers. We made the most millionaires in the country last year. We made 36 millionaires last year. 36. A loan officer at Chase or Wells Fargo, they'll be happy to see 150 grand W-2. Our loan officers, our top girl made $6 million last year. So we got people here making 20 times more income than your banker, and the word spreads fast when people make that kind of money. And they don't have the restrictions that a bank has, and they can close a loan in 5 days or 10 days, whereas a bank's taking 90 days, and our pricing is like half a point better in rate than the bank. So it's faster, it's easier, it's cheaper. It makes all around sense to work with the mortgage broker. But we're the best of both worlds. We're the mortgage broker, banker hybrid. We give you the best of both. And that was the vision for the company, is to give you a complete solution.
I love it. And so the goal here, we're going, up 6 states, up another, hopefully 2 billion in volume, which I'm sure you will. You're looking to really recruit and grow the team, right? And so that's on the ground. How do you see this team looking by the end of 2021? And who are these prospective new recruits that are coming on board?
Well, we're recruiting all of the top talent from all the big mortgage lenders, whether it's, Loan Depot or Network Capital, all the big lenders, Quicken, all the big lenders, when their top talent sees our platform, they flock to this model because they know that the income potential is 10x what they're currently used to. They know that the process is better. They know that loans can close faster. And more importantly, really what I pride myself in is being a thought leader in marketing innovations and automations and the technology. I mean, our tech stack to make this process work is just incredible. I'm on the forefront with these guys. I still try to produce more than most of the people here, just so I can keep my finger on the pulse and figure out the best strategies to help these guys excel. So, me as the CEO and our president, we're still, on the front lines with these guys, helping these guys innovate. And that's a huge benefit because my door is always open to innovations. And any of my branches say, I got this idea, or I'm that guy getting the sales pitch from the LinkedIn guy or the Facebook company pitching me. I'm always, trying to figure out the next new thing. Those guys exist for a reason. I hear them out. A lot of people tune them out because they don't have the budget. They don't want to add anything to their plate. I got an endless budget for R&D. I'll spend whatever it takes to continue to take us to the next level in this business.
I love that. Well, hopefully your inbox doesn't fill up with LinkedIn ads saying they're going to take your Instagram followers to 20,000 people after this one here. But Joseph, this has been great, man. Love what you guys are doing. And I agree, right? The more you can streamline the process, make it easy for people and not make this such a process, right? We can take out the word process and make this just an experience, right? And that's what you guys are looking to do. You're creating.
And that's what we want to do. We want to make it a 5-star experience. We want to make it easier. We don't want to make it daunting. We know that the word mortgage itself has a negative connotation. People don't want the mortgage. They want the house. Yeah. People don't like the term mortgage. They don't want to deal with the process. Like you get me in front of an accountant, I cringe, right? Like they don't like that. So we just want to make it easy. We want to take away that worry and just make it streamlined and just do it all for them and automate everything for them. So it's very, very hands off. And we try to do that for our branches too. Like we try to do everything. There's so much AI and automation because having the loan officer do more work to me is like having the borrower do more work. It's because we have 2 clients here, the loan officer, the borrower. So I try to mitigate both work efforts, whether it's the LO having to figure out how to market themselves or process the loans or whatever it is. I try to mitigate it for both parties, and the bar like having to, submit documents or submit this or that. No, we'll just pull it. We'll go to the IRS. We'll upload it. We'll grab it from your employer. We'll get the W-2s for you, or the tax transcript, whatever it is. It's all about automating everything for the client and for our LOs.
That's awesome. Well, Joseph, great work on what you guys are doing. Look forward to having you back and seeing how much you guys grow in the next year or so. For everybody who wants to find you, what's the easiest way to find eMortgage Capital?
They can find us www.emortgagecapital.com or at eMortgage Capital on LinkedIn or on Instagram or on Twitter. We're just at eMortgage Capital. So
awesome.
Or email me directly, joe@emortgagecapital.com, and drop that in your notes. And I'm always available. I'm always answering questions, guys. I'm never, my door is never closed. So except right now, because I got to be in this podcast.
That's right. That's right. Right. With just limited exceptions. Well, Joe, thanks so much for what you're doing. Super appreciate for having you on the show. We'll talk to you shortly.